Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. So on Friday, we had a continuation of the short squeeze face-ripping 2-day rally that started Thursday. Very interestingly though, guys, Friday was actually led by the Dow Jones, rising 0.8%, leading the NASDAQ, which took a little bit of a back seat Friday as energy, real estate, and industrials as well as financials led the market up, and technology as well as communication services took a bit of a breather. Let's take a look at the stock market map, and very interesting price action on Amazon. We had a face-ripping rally post-earnings in the post-market session, but then Amazon gave up all of those gains when Amazon executives broke the bad news that the cloud computing segment, Amazon Web Services, is going to slow down in the coming months, which is expected, and that resulted in this sharp decline post-market. We had a massive rally all the way to $122 on Amazon, a level that I actually talked about just before the earnings report dropped in my last video. I said that the expected move was $7 in either direction, and that put $115 within reach. But I said I expected the rally to go all the way to this prior resistance level at 120. That's exactly what happened. We had a massive rally post-market, and then all of those gains were given back as the executives warned that AWS is going to continue to slow down. Now, Amazon actually beat on both the top and the bottom line, beating its EPS target as well as revenue target, which allowed the stock to initially rally before the earnings call. Now, interestingly, Amazon actually pulled back to the 9-day moving average, so the uptrend is still intact for Amazon, and I do expect Amazon to actually potentially continue to rally here as this short squeeze continues into next week's Fed meeting and Apple's earnings. I do want to start this video out with the value line index. I introduced this index in the last video for the first time, and this index, guys, looks at 1,700 different components, and they're all equally weighted versus the S&P 500, which has 500 cap weighted components. So it leans very heavy towards a few very large cap names, things like Apple, Microsoft, Amazon, Google, etc. Now, the value line index is a critical index, and here's exactly why. We use this index, guys, to identify bearish and bullish divergences. I'll show you a few examples. We had a bullish divergence where the value line put in a higher low in October versus the low in September, and that actually called the bottom in the stock market perfectly. There were actually half a dozen different divergences, including in breadth, that allowed us to capture this low in October. There are other examples, including this divergence here. The value line put in a slightly higher low as the S&P put in a lower low, and that again allowed the market to rally thereafter. Now, the most important divergence that I actually want to talk about is this. Notice that the value line index put in a lower high in early January of 2022 as the S&P 500 was putting in its final high, the all-time high, right? The S&P made a new high versus November, while the value line index put in a lower high, and that was the final move up before the market put in its final high for the entire economic cycle. This is absolutely critical, and that's because, guys, we have a very similar looking but even worse bearish divergence. Why is it worse? Well, for two very good reasons. The first, guys, is that this bearish divergence is actually significantly longer. And the longer the divergence takes place, the more violent the preceding reaction is going to be. For example, this divergence that marked the all-time high lasted 2 months. This divergence just so far, and I do expect this divergence to actually continue into the middle of the summer, this divergence so far has lasted nearly 3 months, and I actually expect it to last 1 more month before the S&P puts in its final high for the year at $430, 4,300 on the SPX. The other reason this divergence is worse is because of the slope. The slope of the divergence, the decline of the lower highs, is significantly steeper than the decline that we had back here at the all-time highs. Now, the angle of the decline could actually change in the next month or so, so we could see the value line actually make a slightly higher high versus April, but still maintain the larger, longer-term divergence, as the S&P likely makes that final high at 4,300. So as the S&P 500 puts in its final top, what is that actually going to look like? Now, here's my projection. And I actually published this projection in the last video before we had that continuation move on Friday. And in the video, I said that I actually expect the market to continue to rally, then come back down to fill the gap at 395, 395 on the SPY, 3950 on the SPX. So this gap left from late March. And if you remember, guys, I actually said that this gap will likely take a major event to spike volatility high enough to expand the range down by that much. And we do have a few events coming up, including the Fed meeting next week and the Apple earnings as well. Although personally, I don't think that those events will be bearish. That's just my opinion. I actually think the market is more likely to rally on the Fed and on Apple and then pull back after those earnings are out of the way. After the Fed meeting is out of the way, I think the reality of the situation will begin to set in as we get into the second week of May. And I think at that point, we will have made a slightly higher high versus February, and then we will come back to fill the gaps below and to resolve this unfinished business before we continue higher to that $430 level that I talked about. So far, the market is following this projection. Now, to be clear, guys, these projections are based on the most recent available data, including fundamental, fiscal, monetary, as well as technical. And as the data changes, these projections can change, and I will update you when that happens, but I'm very happy with this projection so far, and I think it makes the most sense at the moment. Now, guys, the S&P 500 is up above and the value line index is down below, and this is what I expect for the next little while. I think that the value line index will rally alongside the S&P. It may or may not take out these prior highs. That remains to be seen. We may just make an equal high as the S&P makes a higher high. Then I think we will get that larger correction to fill the gap below at 395. We might actually overshoot that just a little bit, maybe to the 3900 level. That remains a possibility. Then I think we get one more move to the upside, put in the final high for the year around the 4,300 level on the SPX, anywhere between 4,300 and 4,350. And at that point, I expect the value line index to again make a lower high before the overall sentiment in the market shifts to the downside. Now, let's take a closer look at the daily chart for the S&P 500 to figure out where we could go next week. And I want to point out two really interesting developments. The first is this. The fast-moving momentum signal put in a buy signal on Friday on the Money Time Machine Smart Money Flow indicator. And these signals, guys, usually actually mark false rallies. And I'll show you a few examples. This is an example, guys. This actually marked the top. This buy signal marked the top. This buy signal actually marked the last rally in this counter trend move before we continued down further. And this buy signal did the same thing. It marked this equal high before we continued lower. And that's why we don't actually buy on these signals. There are several key conditions to actually go into trades, buys and sells based on this indicator that I went through in detail in my Smart Money Indicator tutorial. Go and check it out if you haven't seen it. This indicator comes totally free with every single community membership in the trading community. If you want to follow all of my work, all of my trades and investments, as well as signals and indicators, you can sign up to join through our Patreon page. And that's the best possible way to support the channel if that's something that you want to do. Other ways to support the channel totally for free is to slap that like button right in its face. And I do appreciate every single like. And by the way, guys, I do read every single comment. So why is this false buy signal important? Well, because it usually comes after the top has already been set. we get one further thrust, and we get this late buy signal. It happened after the top in February and it happened after the top in December. And in fact, the setup actually, guys, looks very similar to the setup back in December, where we had a break below the 9-day moving average, this light blue line, and below the 20-day moving average, this dark red line. Usually after we get a break below the 20, we get one final push back up. Usually this push stalls at the 9-day moving average. Sometimes it overshoots, but usually it stalls at the 9-day or the 20-day, whichever is higher. For example, here it stalled at the 20-day because it was higher. In this example, it stalled at the 9-day because the 9-day was higher. In this example right here, back in April, it stalled at the 20-day because it was higher. So it usually stalls at either the 9 or the 20, whichever is higher. Sometimes it can overshoot, and it overshot back in December, and it's overshooting again. And I actually think the market will likely pull back here for a couple of days ahead of the Fed meeting. Then I actually think the market will rally on the Fed meeting and top either the day of the Fed meeting or the day after on Apple's earnings. And as we do that, we will run into this major resistance level at $422. This gap fill level at 422. I think we will see that gap filled as early as next week. So in this red box, I think the market will find its last leg up at this major resistance level. Then the saying sell in May and go away will take effect. In my opinion, I think the market will reassess all of those earnings results, especially after the majority of these big cap tech companies actually rallied post earnings. The risk to reward after these kinds of moves, guys, tends to shift to the downside, especially as the VIX is beginning to form a major bottom. So a bit of a pullback ahead of the Fed meeting, a rally on the Fed meeting, and potentially on Apple earnings, a top here at 422 to fill the gap, then push back down into the end of May, fill the gaps below all the way to 395. And at that point, I think the market will continue its final wave up to the $430 level. Slightly above that is possible. I think this high will likely be matched or slightly overtaken in the summer as the market puts in its final high for this entire counter trend cyclical bull market within this secular bear market. There's a lot of evidence to suggest that we are still in a secular bear market that actually began back in December of last year, and that this actually is a cyclical counter trend bull run within the context of a larger bear market. This form of market structure is actually very rare historically speaking. It doesn't happen very often. And that's because, guys, this bubble that began all the way back here in late 2018, this bubble has been absolutely massive, and it will take a much longer time than usual to correct. This is what Jeremy Grantham calls a super bubble, and it's very rare. The last super bubble we had was back in 2000. The one before was in the 1920s, so they are extremely rare. In 2000, guys, we did have somewhat of a cyclical bull market within a secular bear market, and it was this move back here. This was a cyclical bull, right? We had a low, higher low, another higher low, as the market was actually putting in its final high for the cycle. And we'd actually need to go back all the way to the late 40s to see another example of a cyclical bull within a secular bear. We actually had a couple of cyclical bull markets within a secular bear market back in the late 40s. And I'll show you a few examples here. We actually had a bullish cross, the 50 crossing above the 200-day moving average. These crosses, guys, usually mark the end of bear markets. In this example, we established a very weak cyclical bull market within a secular bear market. We ended up crossing back down below the 200-day moving average, beginning a new cyclical bull market within a larger secular bear market, and we ended up crossing back down and coming back down. So we actually traded within a defined range, this kangaroo style market, up and down, up and down, up and down, before we finally exited this entire secular bear market. This late 40s environment is actually very similar to the current conditions, and that's for two key reasons. The number one reason is World War II. The entire world was fighting this major war in the 40s, and it drove scarcity in materials and a lot of money printing that resulted in massive inflation in the late 40s. And what did we have back in 2020? We had the whole world fighting a virus. We had shutdowns, we had demand rising, we had production declining, we had a lot of money printing. The same thing, guys. The whole world was focused on one global event that drove both inflation and money printing and drove scarcity of basic materials. This is pretty much the environment that we're living in right now, post 2020, very similar to the environment post World War II. Central banks are trying to fight inflation, trying to hammer it down, pushing demand down by raising interest rates, as the entire world deals with the aftermath of that global event. The good news though, guys, is that on the other side of this equation, a massive bull market likely awaits us. After we finally get that recession and the equity risk premiums adjust, there will be very good buying opportunities. And I'm going to make a video, guys, discussing in detail the equity risk premium and what it means for stock market returns in the next couple of years. Equity risk premium is going to be the number one factor to look at whenever you want to invest, because it really defines whether the market is massively overvalued or whether the market is actually severely undervalued. And what it says right now is the market is actually entering extreme overpriced territory, readings that we actually haven't seen since 2007, right before the recession of 2008. A key chart that is actually forecasting further weakness to come after this quick thrust is done with is the Dow Jones Transports Index in the Dow Theory model. The Dow Theory model tells us that whenever the Dow Transports Index is forming a negative divergence, meaning making lower highs versus the Dow Industrials and lower lows, it indicates that the economy is weakening and that the entire stock market, the overall indices, including the Dow, the S&P, and the NASDAQ, will eventually follow through and come back down. The transports guys tend to lead the market, and there are many examples of this, including the massive bearish divergence that actually marked the high back in January of 2022. And the same thing happened, guys. It marked the high in April, massive negative divergence, more weakness in the S&P. And we also had a couple of bullish divergences here that I actually pointed out as they happened back here in December. It marked the low, and back here in early March, it actually marked a local bottom that sent us higher in a counter trend rally. Right now, the Dow Theory model indicates that the economy is weakening and that these rallies in the S&P 500 are soon going to begin stalling and putting in major highs that send the market lower. Another key chart, guys, that really every investor needs to keep tabs on is the XLY consumer discretionary divided by the XLP consumer staples. And again, we've been making lower highs, consecutive lower highs, and lower lows as the S&P has been rising, indicating that the consumer is actually continuing to weaken and that this rally in the S&P 500 does not actually reflect the poor health of the economy. Now, another key economic indicator is the copper to gold ratio. And again, massive negative divergences tend to mark major tops in the market. Massive bullish divergences tend to mark major lows in the market. And right now we have a gigantic, massive bearish divergence that has actually lasted well over 3 months. And again, guys, the longer the divergence builds, the more severe the reaction becomes. Let's talk about high yield bonds. Smart money is up top. The S&P 500 is down below. And again, I warned about this positive divergence where high yield bonds actually made the higher low as the S&P was crashing. Again, if you watched my last video, I talked about this later in the video, in my last video. That's why sometimes I really feel bad for the folks that don't actually watch the entire video. They tend to miss really key information that I talk about because I put in a lot of effort and energy in trying to distill these videos into the most important parts possible. Otherwise, they actually would end up being over an hour long. So I actually talked about this bullish divergence in the last video and that I expected a bounce to the upside. We actually got this bounce and now I'm expecting the opposite. I'm expecting high yield bonds to stall as the S&P 500 hits that major resistance level that I talked about at $422. Put in that high very likely by next week on the Fed meeting and Apple earnings. And then we see the sell in May and go away effect take place, filling the gap down here at 395 and push back higher to the final high of the year. I hope that makes sense, guys. Let's take a look at the VIX. The VIX has actually taken out this low back in mid-April. We are now squarely below any reading since the all-time highs in January of last year. In fact, guys, we are now in extreme complacent territory, even by bull market standards. And I'll show you what I'm talking about. So this was the insane face-ripping 2021 bull market. And if you notice, we're actually now at the lows of the VIX, at the height of one of the most violent bull markets, the 2021 bull market. We are now at the same levels of those bull market highs. In fact, let me lay over the S&P 500 on here so you can guys see what I'm talking about. Notice these VIX lows actually marked S&P 500 highs. These VIX lows, S&P 500 highs, S&P 500 highs, S&P 500 highs. Even within the context of this very strong bull market. And so even by bull market standards, the VIX is getting very complacent, and it will likely, guys, become even more complacent as we hit that 422 target that I'm expecting. Let's take a look at breadth. Again, breadth making lower highs as the S&P makes higher highs. This is the 50-day breadth of the S&P 500. The 200-day breadth, the longer running breadth, is even more negative. And again, we tend to see these kinds of bearish divergences develop near major tops, and this bearish divergence will likely, guys, last quite a long time as the S&P puts in its final high for the year in the late summer. Now let's talk about the summation index. The summation index put in a bearish cross down back here, guys, in on the 25th of April. This marked a change in trend for the S&P 500. Sometimes we get a change in trend and then a final push back up. And we're now, guys, likely in that final stage, this final push back up to again fill that gap of 422 before we continue down to fill the gaps below. Same thing on the NASDAQ here, guys, a bearish cross on the NASDAQ composite summation index. Sometimes we get a counter trend, a quick counter trend rally, and we are likely in the midst of this counter trend move before the larger correction takes place. Let's take a look at the put to call ratio. We actually had a sell signal April 26 on the put to call ratio. And again, sometimes, guys, we get these counter trend moves before we continue lower. Sometimes we get these counter trend moves before we continue lower. And I think that we are now in the middle of this counter trend move. In terms of economic events, we had GDP come in below expectations, half the growth rate expected, even though the price index came above expectations. Again, this feeds into the stagflation theme, stagnant economy slowing down while inflation remaining resilient. Same thing we're seeing, guys, with the core PCE at 4.6%, only 0.1% below the prior month. However, headline inflation has come down below expectations. Although it's important to mention, guys, that the Fed looks at the core rate and it puts it above the headline rate. So the headline rate is slowing down, but the core rate is still remaining stickier than expected. The stickier the core inflation rate is, the longer the Fed has to maintain high interest rates, and the longer the Fed maintains those higher interest rates, the weaker and the weaker the economy is going to get, and the closer the recession is going to get. In terms of earnings next week, I'm looking at a couple of key earnings here. Monday before the open on semiconductors and NXP. NXP makes a lot of chips for cars, so it's going to give us insight into the health of the consumer. Again, we're seeing consumer discretionary slowing down. If we get NXP warning that yes, demand for these chips for cars is slowing down, that would be, again, an indication that we are getting closer and closer to an earnings recession for companies. Tuesday, I'm watching AMD and Ford. Monday, I'm watching Qualcomm and Etsy. Qualcomm, again, for consumer demand for phones. Etsy for consumer discretionary. And then Thursday, we'll have Shopify and Apple. And in fact, guys, by next week, over 86% of the S&P 500 companies will have already reported earnings. And if we see a repeat of what happened in the last earnings quarter, we'll probably see the market continue to rally as these earnings are reported and then begin to give back all of those gains in the weeks following the earnings season. Thank you for watching the video all the way through. If you enjoyed this video and you want to see more of this type of analysis, slap that like button to let me know. I really appreciate it. If you watched the video all the way through and you did not enjoy it, I thank you and I appreciate your attention, and I'll catch you in the next one. Bye-bye.
Oh, wow.